Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, we're going to cover part 6 of our asset allocation series, and we're going to cover the asset class of real estate. Now, this is a very important asset class, if not one of the most important ones that you need to understand and know if you want to get serious about building wealth, especially if you want to build wealth efficiently. Real estate is the best investment you can make from a tax standpoint. The tax benefits from real estate investing are unmatched really with any other asset class. So it's very important that you consider and understand why you should have a piece of your portfolio allocated to real estate. So in this video, I'm going to walk you through the different types of real estate investments you can make, the different ways you can practically invest in real estate. I'm going to talk to you a little bit about how I personally like to invest in real estate. And at the end, we'll talk a little bit about how you should think about how much of your net worth you should allocate to real estate investments. So let's go ahead and dive right in. I want to start by, again, just a reminder, as I do with all of these asset allocation videos, that we are talking about allocating your money across the different asset classes. These are the main asset classes I personally consider when I think about what you can invest in. And we're also going to talk about how to allocate within this asset class. So we're going to talk a little bit about what it means and as far as how you should think about allocating your money to real estate investments. Then we'll talk about how you should think about allocating your money within the asset class of real estate investing. So to start with, I want to be clear, I'm not going to spend a ton of time on diving into the specifics about different types of real estate that you can invest in and all of that type of stuff. I could really spend days on just real estate investing itself. It's really probably one of the most complicated as far as different things you can cover, and you can get into all the different nuances of the different types of properties you can own. But I want to start by being clear that there are a lot of different types of real estate that you can invest in. It's not just going out and buying, single family homes where you're going to own a property that you rent out to, another family to live in. It's also not just owning apartment buildings. It can be things like owning self-storage units where people store their goods that they don't need and don't want to keep at their house. It can be things like special purpose real estate. So that could be, anything really, real estate for wedding properties or anything like that. Medical facilities, like if you live in New York City right now, there's tons of kind of post-COVID, development of different medical facilities, senior housing. So we know there's going to be a lot of baby boomers retiring soon. So they're going to need a lot of, places to live when they're older and need senior living. So there's all different types of real estate. You should think about, as you're investing in real estate, really diversifying amongst these different types of properties. You don't want ever 100% of your money in one type of property. You want to try to spread that out as much as possible. It's unlikely you're going to invest in all of these. I think investments in most of these different types of real estate, but not all of them. The one thing I do want to point out is a lot of people think that investing in real estate can also be done via debt. So if it's some sort of real estate debt, like for example, you may be part of a group that's lending to a fund or a group that wants to go out and purchase apartment building. I do not consider that investing in real estate. I would consider that investing in debt. I don't invest in debt, generally speaking. If you don't understand, my thought on that, check out my prior videos in this series. But I do not consider owning real estate debt or investing in real estate debt to be an investment in real estate. You lose a lot of the tax benefits, you use a lot of the upside potential there. And I just don't do it. And I would not consider that in conjunction with what we're talking about in this video, which applies to just pure real estate investing. So let's talk a little bit about how to invest in real estate. So I'm not going to get into, going out and buying properties and how you identify what properties you should buy and that kind of thing. That is really not what I'm here for. I'm going to talk to you about the strategies for how you can invest in real estate. So these are kind of the practical ways that you and I can invest in real estate. We've all probably heard of REITs. I think this is probably the most popular way to invest in real estate. I think, a lot of people are under the misconception that this is how you should invest in real estate. I do not own REITs. I will never own a REIT. I'm not a fan of them. I have a video on that. Check that out if you want to see how I think about that. But REITs are really they're usually publicly traded. They're not always publicly traded, but they're usually very large publicly traded companies that are investing in real estate. So you can kind of usually trade, ticker symbols of REITs the same way you would buy and sell stocks. But again, I don't like investing in real estate that way. I think you lose a lot of the key benefits of real estate investing. So I'm not a fan of that method, but that is a way that a lot of people think about investing. So you can also go out and buy properties yourself. So You may go out and just start acquiring, properties, whether it's, properties that you're going to rent out on a month-to-month basis, and where you have someone coming in and signing a lease, or it could be short-term rental. So the short-term rental strategy is very popular lately with things like Airbnb and VRBO. That is where you go and, you list a second property that you own, or, however many properties you own, and you rent them out on a very short-term basis. So it's like people coming to stay for a weekend or a week at a time. It's not really long-term leases. So these are the two really strategies that you can use. These are really tax strategies, but there are practical ways that if you're going to go out and buy properties yourself, you should be thinking about using one of these strategies. So real estate professional, you're basically going to be in the business of, leasing out or, owning real estate properties. You've got to spend over 750 hours a year on that real estate business. It can be kind of cumbersome to satisfy the requirements, the time and documentation requirements. But if this is something you're willing to do and you're serious about it, then this is a great tax strategy. I love this strategy. If you have one spouse that's a W-2, especially high earner that earns a lot of W-2 income, that's very tax inefficient, but they make a lot of money, then it's a really great strategy to have the other spouse be the real estate professional. So I have videos on that if you want to learn more about that, but this is a great way to do it if you're going to own properties and you don't want to do the short-term rental strategy. So the short-term rental strategy, I'm not going to dive into that again. I have videos on all of this other stuff. So go check out, those videos on my channel if you want to learn more and dive more into any of these, but I'm not going to spend, that much time on this now. But if you don't want to own properties where you're looking at, leasing out the properties to someone on a, maybe you have them sign an annual lease, for example, a lot of people like the short-term rental strategy. So this may be you own a couple of properties throughout the country or, near where you live, wherever, and you want to rent those out by listing those on Airbnb. So this can be a great strategy if you're someone who wants to own properties, but you don't want to satisfy, the really difficult time requirements of being a real estate professional under the tax code. The short-term rental strategy might be a great option for you. You can spend a lot less time and do a lot less and still qualify. I personally love this strategy for anyone who wants to have a vacation home or second home, and you want to monetize that property and, get some tax benefits from that. So I personally am not a fan of going out and buying properties myself. I don't want the hassle. I don't want to spend a lot of time on it. I'd much rather focus on my business and just spend time with my family. So I don't do these two strategies. However, I have done the short-term rental strategy before for a second home. So for example, I had a home in Cape Cod that, we went there so much before we had, a child, but we would go there all the time. So I bought a property there. We monetized it by renting it out. And I did this short-term rental strategy. So it's a great strategy if you're someone who goes somewhere a lot and wants to own a home there, but you don't want that to just become a liability. You want to try to monetize that asset. So that's a great strategy that I like for this as well. If you're not someone who wants to go out and just manage a bunch of properties, I've personally never wanted to be in the business of managing real estate. So what I do is I invest very passively through real estate syndications and real estate funds. These two strategies are really if you want to passively invest in real estate and get exposure to that asset class, but you don't want to spend a lot of time yourself. So I don't want to have to talk to plumbers. I don't want to have to arrange for electricians to come fix something. I don't want tenants calling me in the middle of the night because there's something wrong with my property. So I like doing this. I'm happy to pay the fee to let somebody else manage that. And these are really big, sophisticated, entities that are doing these syndications and funds. You're going to work with a sponsor who, does this professionally, and you should do your due diligence and find really good quality sponsors to work with. Then they're probably going to be able to find deals and manage properties in a way that they make more money even after their fees are taken into account than most of us could do on our own. So big fan of investing this way. Syndications and funds, a lot of times those words are used interchangeably, but a syndication is really when you have a sponsor that's putting together, a deal for like one or two properties. It might be, for example, I've invested in syndication that was an industrial property in Texas. So, when you're investing, that's what you're investing in. It's that property, or it might be a couple properties, but it's a really, small deal in the sense of types of assets you're going to own. Those can typically have higher returns, but they also have higher risk because you're not diversifying, within different properties. Whereas a real estate fund, they usually invest in multiple properties. I'm invested in real estate funds that own 50 properties or more. Some of them own hundreds of properties throughout the US. I don't even have any clue sometimes, what you're investing in with the fund. to some extent, but you're trusting the sponsor to go out and manage that money across the different real estate investments that they make. So again, if you want to check out any of this stuff in more detail, these strategies for how to invest, check out the other videos on my channel. I dive into this a lot, but I want to be clear. I'm not touching REITs. I don't think that's the smart way to invest in real estate. I personally like these two strategies because it's not where I want to spend a lot of my time, but I can still get all the same benefits of investing in real estate from both a tax and non-tax perspective. So I want to talk a little bit quickly about why I'm such a fan of real estate investing. So to start with, I've said this, but it's very clear you understand real estate is the best investment you can make from a tax standpoint. It might not be the best investment you can make overall, but it's the best type of assets that you can invest in from a tax standpoint. The tax benefits are just unmatched from any other asset class. So you need to understand that. You need to factor that in when you're thinking about the returns you're getting, because as always, we want to think about our investment returns on an after-tax basis. So again, to start with, just a couple of key benefits of why I like, they're both tax and non-tax reasons, but to start with, it's tax efficient. You can, in some cases, avoid tax on 100% of your income and gain for life. So you can really, there's strategies that you can avoid paying tax on the investment income you get, rental income that's kicked off from the properties as you own them, as well as you can avoid tax on the gain when you sell the properties. Those benefits of, avoiding tax on the gain when you sell the properties isn't always available, especially if you're investing through a fund or a syndication. But it's important to understand that there are very tax efficiencies to investing in real estate. And that's the number one, one of the main reasons why I make these investments in this type of assets. It's also typically thought to be a safe asset class. We know real estate can, of course, lose its value. No asset is ever promised to, not completely lose its value, but typically and historically, smart real estate investments have held their value. They may have dips, where there's just a downturn in the real estate market, but you shouldn't need to sell. You should have, things set up and plans for that and be able to hold it until it returns its value. So properties, they don't go up a ton usually, unless you're speculating, which I don't really do on real estate investing, but they typically go up over time and they typically retain their value. So that's a great, way to have exposure to a safe asset class. A big benefit of real estate investing is that you can use really low cost debt. So that can help you increase your returns. You can buy properties where you're putting down as low as 20%, some cases lower, and you're able to buy properties that are going to kick off significantly more money because you can use debt to increase your returns. So, and with mortgages on properties and rental properties, usually that's a very low cost compared to business loans, for example. So the interest rates are usually much lower because it is generally a safe and stable asset class. So banks are happy to lend against that because if for some reason you stop paying on the loan, they can come in and foreclose on the property and have that as collateral on the loan. So I love the ability to use leverage to kind of maximize my returns and gain efficiencies there on real estate. Also, real estate investments typically have stable performance over time. A lot of that is because of, a lot of the things I've talked about before. But I expect when I invest in real estate, and again, I'm investing through funds and syndications, I expect the returns to be around 12 to 18%. So if you go out and buy properties yourself, then you may get more than that. There are ways to get higher returns than that. You may have funds that just, knock it out of the park and make higher than that. But on the low end, if I'm invested in a fund and it's making less than 12% on average returns a year, I'm not going to be very happy. It's going to be the last time I invest with that sponsor. So typically my expectation is that the return should be, above 12% and usually in that 12 to 18% range. REITs are probably not going to be anywhere near that because they're just not as efficient. It's a completely different type of investment. So that's one of the many reasons I don't like REITs. But again, you have to do your due diligence on quality sponsors if you're going to invest through a fund. If you're going to buy properties yourself, you got to be smart, run the numbers, run your models, understand what you're investing in and what the expectations are. But you should be targeting around that at a minimum. Also, big fan of the buy, borrow, die tax planning strategy. It's the strategy where you buy assets that you're happy to hold, for life or for a very, very long time. Real estate is an asset that you can own forever. I know people, I live in New York City, for example. I know people who own properties in New York City that have been passed down from generation to generation. So their grandparents may have bought something back in the day when people could actually, more easily afford very large buildings in New York City. So you can own those assets for life, and they're great assets to use for the buy, borrow, die strategy. So one thing I love about real estate is it's an asset I'm happy to hold for the long term. Also, because I invest through funds and syndications, I don't have to do anything. I don't have to lift a finger. I have to do my due diligence on the sponsor I'm investing with, the fund manager, whatever you want to call them. And I have to make sure the deal I'm investing in makes sense. So I don't want to invest 100% of my money in apartment buildings in Texas, for example. So you have to make sure you're diversifying, with sponsors. You don't want all your money with one sponsor. And you also don't want all your money in the same types of deals. So you got to diversify. But other than that, I'm hands off. I read the reports that they send me for updates, but I don't have to lift a finger. Nobody's calling me in the middle of the night because the toilet's clogged or something like that. So I call that mailbox money. You just sit back, you make your investment, and you start getting your distributions. They just show up in your bank account. Usually it's once a quarter. Sometimes some funds will do monthly, but it just shows up and you really don't have to do anything because you're a passive investor. So these are the key benefits. There's a lot of other tax and non-tax benefits to real estate investing, but I just want to highlight the reasons why I love this asset class, and I will always have a lot of investments, a lot of my net worth invested in real estate assets. So I just want to end a little bit with, we know why we want to invest in real estate. Now let's talk about how much we should allocate to real estate and how we should allocate that money within the real estate asset class. So as always with these videos, I break it up based on stages. There's going to be different types of investments that you can make depending on the stage you're at. If you're a non-accredited investor, you're not going to be able to invest with quality sponsors. So that means the funds and syndications, they're off the table for you until you're an accredited investor. And, you're going to have to, if you want to invest in real estate and get serious about building wealth, you're probably going to have to go out and buy properties yourself. So if there are funds or sponsors or ways to invest in real estate that is open to non-accredited investors, I would not touch that. They're usually not good quality, avenues for investing. But, if you want to get serious about building wealth and doing it tax efficiently, then you're going to have to go out there and buy a couple of properties. I did this early in my stage. When I was willing to do more and, answer those phone calls when they came in at any time of day from tenants, I was willing to own properties at that point. I'm just not willing to at this point in my life. But, that means you're probably going out and buying properties. It could be the short-term rental strategy. It could be real estate professional strategy. It could be a REIT if you want to. It's not my cup of tea. But once you hit accredited investor status and, qualified purchaser status, you're going to be able to invest in pretty much every fund and, syndication that's open to taking investors. And that's going to open up a whole new world of being able to invest in different types of real estate deals passively. So what I would do is I would focus on where you are in your stage of, wealth building. If you're non-accredited, I typically think 10 to 15%, it doesn't have to be in that range, but you want to be targeting that type of range, and you want to be allocating some of your money to real estate as soon as you can. When you're a accredited investor, I think of upping that a little bit because, you can invest in real estate through funds and syndications. You don't have to spend time on it. So I like to up that a little bit. I try to target around 20%. And again, that's various different types of real estate deals. Doesn't have to be that much. It could be more, but that's a good benchmark I like to look at. But when you're a qualified purchaser, you can, think about there's going to be even more types of deals that you can invest in beyond just these real estate funds and syndications. So maybe you scale back real estate a little bit because there's going to be new asset classes available to you. So this is where I, scaled back once I hit qualified purchaser status, scaled back and started focusing on some other asset classes that weren't available to me when I was a credit investor. So I typically target 10 to 15%. These are benchmarks. I don't care whether you're in this range or not. You need to make your own personal decision on what's the best amount for you, but you need to be focusing on getting some allocation to real estate. You've got to, as early as you can, when you're wanting to get serious about building wealth and becoming financially free, you're going to have to think about doing that through different streams of income and different asset classes, and real estate is a great way to do that. So when you're investing in real estate, let's talk about layer 2, which is, okay, we've allocated X money to real estate investments. How should we allocate that money across the different types of investments I can make? So when you're a non-accredited investor, you can't be too picky. You can't invest in funds, where you can go out and be a small owner of very large apartment buildings or industrial complexes or medical buildings, things like that. That's not going to be available to you when you're non-accredited. So you really just want to do anything you're willing to do. So whether it's Airbnb properties, whether it's, houses that you're going to go out and, a lot of people like to start with like townhouses. You go buy a couple townhouses and find tenants for those and start to build that portfolio that way. I don't really care as long as it's a smart investment. You want to just start investing what you can at that point. When you get to a credit investor and you can start investing in real estate funds and syndications, then, that's going to open up a lot more to you. So I would think about targeting 10 to 25% each type. So that means, if you're going to do 25%, maybe you have 25% in apartment buildings, maybe you have 25% in single family residences, maybe you have another 25 in industrial complexes, and maybe another 25 in student housing and senior living. Whatever you want to do, you want to start breaking it down within those real estate, types of properties. You don't want 100% or most of your money in one type of real estate investment. Same with qualified purchaser, think about even further diversifying. There's ways, I'm not going to dive into it in this video because it gets very complicated and into some of the more sophisticated tax planning strategies and investment strategies. But when you're a qualified purchaser, you want to start thinking about, even further diversifying. You might have access to different types of vehicles where you're actually able to come in through maybe the general partnership side of the real estate investment. So you're kind of getting exposure to the different side of the table there. That is through what we call GP stakes investing. But, just think about breaking it up as much as you can. You don't want all your money with one sponsor. You don't want all your money with one type of, property or one type of fund that's making investments. You also don't want all your money concentrated in one part of the US. So make sure you're geographically diversified as well, in addition to just not putting a ton of your money with one sponsor. So this was part 6 of the asset allocation series. This is real estate. I think this is one of the most important parts that we're going to cover. So this is something that anyone who wants to get serious about building wealth and potentially achieving financial freedom early in life, you have got to understand how to best work in real estate investments into your investment portfolio. So hopefully you found this video helpful. If you did, please like the video and subscribe to the channel, and stay tuned for the next parts of our asset allocation series.